Now the straddle. The straddle is very interesting. The straddle is a combination of a call and a put, but at the money or at the same strike. So for example, SPY is at 350. I can look at the 350 strike, and the straddle is trading for about 1164. So what is it composed of? Basically, it's the call option and the put option at the same strike. You could either buy them or you could sell them. So if you buy them, you're paying $12. So same idea as buying a call or a put alone, but basically you're paying for both at the same time. So what does that mean? So that means you expect, for you to start making money, you basically need the SPY to move 350 plus what you paid in total for the call and the put. So your break-even zone is 350 plus, let's just round it to $12. So your break-even is 350 plus 12, so 372, and 350 minus 12, so 338. So you start making money if SPY moves above 372 or moves below 338. So basically you would buy a straddle if you are expecting movement from the stock, but you don't know which direction it's going, but you just know that it's going to move hard. So this is what you would do. This is the trade you would take. You would buy the straddle and you would hope for the movement. And in this case, by September 18, if I buy the straddle, I'm either expecting the SPY is either going to go above 372 by September 18, or it's going to go below 338 by September 18. And that's how I start making money. So if it's trading at 330, for example, my profit will be $8 because my break even is 338 on the low side. So 330 minus 338, that's the $8 profit that I would make because I paid $12 for this straddle. It's going to cost me $20 to sell it. Same thing on the upper side. If SPY is trading at 380 at expiry, well, my break even on the upper side is 372. So my profit is $8 once again. 380 minus 372 is $8. I'm going to sell the straddle for 20 and I'm going to buy, but I bought it initially for $12. And if we look at the individual legs, if SPY is at 370, my call option is going to be worth $20 over here. 370 minus 350, that's $20. My put option is going to be worth $0 because it's worthless because the stock is above my strike of 350. So what I pay $12, I get to sell now for $20 because this call option is worth 20. This is worth $0. So I'm selling for 20 when I paid 12. So my profit is $8. If we look at, if the SPY drops to 330, my call option will be worth $0 because it's out of the money. My put option will be worth 20. 350 minus 330 is 20. So the combination here gives me a $20 selling, but I paid $12 to get in. So that's my $8 profit right there. But if SPY stays between 338 and 372, then I will lose money. And it'll depend where it lands in between. If it lands exactly at 350, I lose all my $12. But if it lands, let's say at 360, then this is going to be worth $10. This is going to be worth $0. So I get to sell for $10. I paid $12. So I'm going to lose $2. I keep saying 372, but I meant 362. 350 plus 12 is 362, not 372. So my break even, sorry, I'll repeat, is 338 on the downside, on the low side, and 362 on the high side. So 350 plus 12, 350 minus 12. So if SPY is at 370, 370 minus 350 is 20 on the call side. 20 minus 12 that I paid is $8 profit. But if it's at 380, then it's actually $30 on this side, $0 on the put side. 30 minus the 12 that I paid, then I'm actually making an $18 profit on a $12 investment. So that's for buying the straddle. But remember, we can buy or we can sell options. Now, what if we sell? So that means we go into the trade selling first. So if we sell the straddle at 350, expiry September 18 on the SPY, we're collecting that $12 first. So that's one contract, that's $1,200 that comes into our account. We collect that first. For us to make money now in this case, we need the SPY to stay between our break-even zones. So we need it to stay below 362 or below 338. So we need it to stay below 362 or above 338. That's our break-even zone for us to start making money. If it goes outside that range, then we're going to pay more than what we collected, and the difference is our loss. But this is a naked strategy. Compared to the vertical, the diagonal, and the calendar, it was a combination of calls and calls or puts and puts. So we were selling one and buying one. So the one that we bought or the one that we sold usually offset the other one in terms of max loss or max profit. In this case, we don't have two calls or two puts. We have one call and one put. So the loss in this case is unlimited. We could lose potentially, we don't know how much we could lose. We don't know what the SPY could be trading at. If the SPY is trading at 400, I'm going to lose $50 minus what I collected, $12. So I'm losing $38 times 100, so $3,800. So because it's a naked trade, there's no protection on the trade. We could potentially lose more than what we collected. And that's for selling. But when we buy options, our max loss is known. Our max loss is what we paid in, but our profit is unknown. Our profit could be unlimited. If SPY happens to go to 400, then we would make $3,800 in profit. So you can see it's just the inverse. Basically, if I buy or sell, it's a different assumption. It's the opposite assumption. So I would sell the straddle if I think that the SPY does not have that much movement. If I expect that it's not going to move that much by September 18, it's going to stay somewhere close to 350, and my zone, it's not going to move more than 12 points either side, then I would sell the straddle if that is my assumption. If SPY closes, let's say at 350, let's say SPY closes at 355, then my profit would be 12 minus 5, so $7 profit. Because I collected 12, I'm going to have to buy back this trade for 5, so my profit is $7. This put option, if SPY is at 355, this put option is going to be worth 0 because it's out of the money. This call option is in the money by $5, so 355 minus 350 is 5. So I'm going to end up paying $5, but I collected $12. So the difference is $7 profit. So as long as you can calculate the value of the option at expiry, you can understand any of these strategies combined. Simply by taking the value of each leg at expiration, you can figure out how much the combined trade is going to be worth at expiration based on the market price.